Howdy, Jacob here. Today we're looking at the company AWRE in the software industry. Just a 37 million market cap on 10 million enterprise value, founded in 1986. Sorry, not that old. First thing I like to do for very small companies is look at their insider ownership, and we do see 44% held by insiders. That's great. Great to see that the board and CEO, CFO, the big man, the people that make the big decisions have a stake in the business. Uh, you really like to see that revenue growth. I mean, pretty small, actually negative over the last 10 years for such a small company. Not quite what you want to be seeing. The margin side, the gross margin is absolutely fantastic, but their operating margin has been negative the last couple of years. If we look at that, it's due to cost of goods sold is actually extremely small now. It really just holds about $1 million of the revenue taken out. But we do see that sales and their R&D has gone up quite a bit, leading to their operating profit margins actually zero. From a share perspective, relatively flat there. Balance sheet, they have 29 million in cash and equivalents, as well as short-term investments with no short-term, no long-term debt. So very safe from a balance sheet perspective. Their cash flow is also negative. So kind of tough here. It looks like they are investing a lot through research and development, but it's not quite showing yet through revenue growth or um, finding, efficiencies to increase margins and such. And so I think we can start making some assumptions here, but it's going to be tough to make some assumptions based on them being having negative margins the last couple of years. So on the growth side, it is still a very small company. I don't know much about it, so I'll probably be pretty conservative here and just say that looks like you provide biometric software products and solutions for government agencies, commercial entities. Okay, company offers. Yeah. All right, so yeah, I mean, I just don't know why another company couldn't do this, and they just have, these great gross margins and probably be way more efficient on the operating margin side. So I feel like, you're going to have to increase your discount rate or put a discount on the P price for cash flow based on the fact that what's stopping a bigger company from doing this and just being more efficient at it. So let's say 3% revenue growth, 13 P price free cash flow, um, 15% return. Let's do, margins. It's not including negatives, but let's do fairly large range of 4 and 8%. Share change relatively flat. Maybe let's say they buy back 1% of shares if they have these margins. So they are investing quite a bit. I mean, here's what I'll say. These numbers right now say that it's nowhere nearby. Couple things to keep in mind. If you understand what they're investing in and how you can see profitability ahead, you can see large growth ahead, then absolutely, I think that you could make this seem like a great business because they are still so small, and so they do have the possibility of, getting acquired, and based on their balance sheet being so conservative, and then having, way more cash on hand than debt from a net perspective. I mean, you're looking at 29 million here, 11 in total debt. That's 18 million, and their market cap's 37 million. So, I mean, if their market cap were to fall 50%, I mean, then they're a net company where they have more cap. If you were to buy the company, you could just pay off all the liabilities, liquidate the business, and you have more cash than what you purchased it for. That's what a net is. I have a video on that if you want to watch that. But anyways, I feel like I just don't see. I see them trying to grow, but I don't see the fruits of the fruition yet, which absolutely could be coming. And if you understand this business better, then better for you. And I hope that it works out in your favor. But for me right now, based on what I'm seeing, I just don't see that path yet. And the last thing to keep in mind is that the company is on the NASDAQ, I believe. Yep. So it's a NASDAQ company. If your stock price goes under $1, then you fall out of compliance with NASDAQ, and then you have a couple of months to, I think you have like half a year to where if it doesn't go above it for a certain period of time, then you could be in trouble. So just something else to keep in mind for a company with a stock price so little. But to me, I think that, you know, I'd probably wait till it maybe became like a net to where you get that absolute safety net. Because right now I don't see where the safety is outside of a safe balance sheet. But if the company keeps using the cash due to having negative earnings and negative free cash flow, it's just going to keep going down, keep going down. That safety net is going to keep getting lower and lower and lower until you're already at the ground, and it's not going to be helping you out anyways if you fell. So hopefully you enjoy the video, and have a fantastic rest of your day. Thank you.